morning and welcome to this lecture on Introduction to Accounting and Finance for Civil Engineers. In the last week, you have been exposed to various definitions of cash flows. Now you are in a position to draw different cash flow diagrams for different situations. You have also been told regarding various methods of evaluation of different alternatives, such as the present worth method of comparison, the future worth method of comparison, the annual equivalent method, and rate of return methods of analysis. If you remember the various assumptions that we used in analyzing alternatives using these methods, you can very clearly note these following assumptions. For example, the first assumptions that we made in the analysis was that cash flows are known. So, whatever cash flows we assumed, whether in the form of inflows or outflows, we assume them to be certain. We will also see situations in which we will try to analyze what happens if there is uncertainties involved in the cash flows. The further assumption was that the cash flows do not include the effect of inflation. We will see how to take care of inflation in subsequent lectures. Further, the interest rate that we assumed for our analysis purpose, we assumed that it is known and known with certainty. There is no change in the interest rate over the entire period of the analysis. Further, one of the assumptions that we made was there is no tax implication for our incomes. Although all these assumptions what we are stating just now, you will find them, none of them are practical. In practice, cash flows will never be known with certainty. In practice, you will always find there would be effect of some inflation. The interest rate, as you know, very frequently they are revised, and you already know that whether it is personal income or corporate income, they have to be given the taxes. Now, one of the assumption is that comparisons whatever we are making, they do not include intangible considerations. So, anything that we can't measure in terms of money, we are not considering them for our analysis purpose. Now, two very important assumptions are like this. The first one is, let us say you have n number of alternatives. In the first alternative, let us say you are investing 100 rupees, in the second alternative you are investing let us say 150 rupees, and in the third alternative let us assume you are investing 200 rupees. Now, through our analysis, let us assume that we find that the 200 rupees investment option is coming to be the most economical option. In that case, you just can't complain that sorry, I do not have this much money. So, this analysis assumes that we have plenty of fund, and in case we choose to find that the highest investment option is the most economical one, we have plenty of money to fund that. On the other hand, we also have one more assumption in which we assume that suppose we are going in for 100 rupees alternative. That means, we are going in for least investment alternative. That means, we find that through our analysis that this alternative is the most economical one. In such case, again we can't complain that what will I do with the money which I am having surplus. So, the analysis assumes that we have plenty of money to fund even the highest investment option, and we have number of opportunities available should we go in for the least investment option. Now, while going through all those methods of evaluation, you might have noticed one very important point, that all these methods are to be used only for comparing two alternatives. So, whenever we have got more than two alternatives, none of these methods are useful. This is because you will find that there are certain problems associated with the methods which we have learned so far, and because of those problems, we will see what are those problems. Because of those problems, if you try to use those methods for evaluating more than two alternatives, you will find your answers are going to be wrong. So, in this class, we are going to learn incremental method of analysis. The principle of this incremental method of analysis, whether it is incremental rate of return method of analysis, or whether it is incremental present worth method of analysis, or it could be incremental future worth method of analysis, the underlying assumption is that every single rupee is as good or as bad as the other rupee. So, if we are getting a particular return on, let us say, first 100 rupees, we must get either the same return or even more return for any additional investment that we are making. So, this is the fundamental assumption behind incremental analysis method. So, let us say we have got different alternatives available to us, and each of these alternatives require different amount of investment. In such case, how do we evaluate various alternatives? How do we select the best alternative out of a number of alternatives is the subject matter of today's lecture. Now, there are very systematic ways to calculate the incremental rate of return for different alternatives. We try to learn this with the help of one small example, but before that, if you recollect the last two assumptions which I just now mentioned, those assumptions are also applicable here. So, when you arrange the alternatives in an ascending order and you find that the highest investment option is the most preferred one, in that case you can't complain that I don't have enough money. Likewise, you can't complain that what will I do with the surplus money if I happen to go with the least investment option. So, these are the assumptions which I told you just now. The analysis makes the assumption that sufficient funds are available, and the second assumption is there are opportunities available to utilize the surplus funds in case you are finding that the lower investment option is the most desirable one. Now, as I told you, we will try to list out the various steps. So, the problem is you have got n number of alternatives. So, in the first step what I do, I arrange those alternatives in ascending order of their initial investment. So, suppose in one case you have 100 rupees to invest, in another case 150, and in another case you have 200 rupees to invest. So, the first thing that I do is to arrange them in an ascending order, right. Then if it is possible, I will calculate the internal rate of return for each of these alternatives. Now, from your past lectures, you are now in a position to understand that not in every situation you will be able to find the internal rate of return. So, if your cash flow diagram is, let us say, cost dominated, or if it is revenue dominated, you will not be in a position to find the internal rate of return. So, that is why I am telling, in case it is possible to calculate the rate of return for the given cash flow diagram, find it out. So, likewise, if it is possible, I calculate the internal rate of return for each of the alternatives that is given to me. Now, the first stage of analysis, what I do, I compare the internal rate of return which I obtained just now with the minimum attractive rate of return. If you remember, the minimum attractive rate of return is that rate of return below which no company would like to go for business. So, the first step what I do, for each of the alternatives I calculate the IRR, that is internal rate of return, and I compare it with the minimum attractive rate of return. Okay. This is what the various steps are listed here. You can see the first step is to list out all the alternatives in ascending order of their first cost or initial investment. In the second step, as I told you, you have to find out the rate of return if it is possible. If it is not possible, I will tell you how to calculate the rate of return through some other manipulations. Once you have compared the internal rate of return with the minimum attractive rate of return, you have to make a decision now. In case you find the IRR is greater than minimum attractive rate of return, this alternative will go into the second stage of analysis. However, if I find that internal rate of return is less than the minimum attractive rate of return, then this alternative does not go in the second step of analysis, right. Now, having done this preliminary screening, now what I do, I compare the least investment option with the next higher investment option, and I prepare a cash flow diagram, what we call it as the incremental cash flow diagram. In that I see what is the benefit that I am getting by investing extra sum of money over and above the least investment option. So, if I find that this extra investment is also yielding me a return more than minimum attractive rate of return, it means the additional investment is desirable. So, in that case I go for higher investment option. On the other hand, if I find that this extra investment is not yielding me a return more than MARR, then I drop the higher investment option. So, what I do such analysis in a pairwise manner. So, I take the least investment option, compare it with the next higher investment option, select the two, select out of the two whichever is the best one, whichever is giving me a return in excess of minimum attractive rate of return, and this process continues till I get one final answer. Now, whatever steps I told you just now, it will be more clear if we take one small example. In this example, we are given 4 alternatives A1, A2, A3 and A4. For each of the alternatives, we are given the initial investment. For example, in A1 we require 30,000 rupees, and corresponding to this investment we are getting a return of 8,000 annually for next 10 years. The salvage value for this particular alternative is given to be 3,000. Likewise, we are given the details for alternatives A2, A3 and A4. Now, as I told you, in the first step we organize each of these alternatives in their ascending order of initial investment. So, that way if you see these alternatives can be written like this: A1 requires 30,000, A2 requires 22,000, A3 requires 75,000, A4 requires 70,000. So, these are the initial investment given to us. Now, what I do in step 1, I arrange them in ascending order of investment. So, the least investment option with us is A2, which requires 22,000 rupees. It is followed by A1, which requires 30,000. Then you have A4, which requires 70,000, and finally you have A3, which requires 75,000. So, as far as step 1 is concerned, we are done with this. We have organized these alternatives in the ascending order of their investment. Now, what I do for each of these alternatives, I draw the cash flow diagram and I try to find out the internal rate of return. Then subsequently, we will compare this internal rate of return with the minimum attractive rate of return of 20%, which is given in this problem. So, let us try to do with the least investment option first. So, it is A2, as you know, it requires 22,000 initial investment. So, at time t is equal to 0, we have 22,000, and then every year it is giving me a benefit of 6,000 for next 10 years. So, this is at time t is equal to 0, this is year 1, this is year 2, this is 6,000 again, and then finally at the end of year 10 we have got 6,000, and you are also given that the salvage value is 2,000. So, this also I keep it here at the end of year 10. So, having drawn this cash flow diagram, now I am in a position to find out the internal rate of return. That will be the first method. In the second method, what we do is, instead of finding the exact IRR, listen to me very carefully, instead of finding the exact IRR, I will simply find out whether the return that we are getting out of this project is more than MARR of 20% or not. MARR is given to be 20%. So, for that what I do, I calculate the NPW for this particular alternative. As you know, NPW we can calculate it like this. So, this is minus 22,000 plus 6,000 multiplied by P given A for 20% interest rate for 10 years plus the salvage value, which is 2,000, P given F 20%, 10. So, this is coming to be minus 22,000 plus 6,000 multiplied by this factor is 4.1925 plus 2,000 multiplied by 0.1615. So, you will calculate this value and you will obtain a positive value of 3478. Now, this NPW of positive 3478 represents that we are getting an internal rate of return more than 20%. So, this is what we require. We simply want whether the internal rate of return for our alternative is more than MARR or less than MARR. We are not bothered at this point of time what is the exact value of IRR. Our purpose is solved the moment we know that the IRR is more than MARR or less than MARR. So, in this case, since we are getting a net present worth of plus 3478, it indicates that IRR is greater than 20%. Okay. So, likewise what I do, I find the IRR value for each one of these alternatives, and depending on whether IRR is more than MARR or less than MARR, I can take a decision. For example, if you look at alternative A2, we find that we are getting positive value. So, we take it for the next stage of analysis, then I do it for A1. A1 also in the same manner, if you calculate, you will find you are getting a net present worth of 4024.5. So, here again it is positive. So, it means that we are having an IRR of more than 20%. So, this will also be taken to the next stage. But when it comes to alternative A4, if you see, you find that we are getting a negative net present worth, which is equal to 10,659 in negative. So, we say that this alternative is not to be taken in the next stage of analysis. Likewise, if you do it for A3, there we are getting net present worth of positive. So, we can say that this A3 also can be taken to the next stage. So, out of A1, A2, A3 and A4, for the next stage of analysis, we take it only 3 alternatives. Those 3 alternatives which are going for the next stage are in the order of ascending investment. A2, we are taking it to the next stage, then A1 also we are taking it to the next stage, and finally A3 we are taking it to the next stage. So, out of 4, alternative A4 is not going to the next stage because the return that we are getting is less than MARR. Now, A2, if you remember, we are investing 22,000. A1, if you remember, we are investing 30,000, and A3, if you remember, we are investing 75,000. Now, in the second stage, what we have to do is we have to carry out pairwise comparison. So, if you see, the lowest one is 22,000 and the next higher one is 30,000 investment. So, what we have to see here is what is the benefit that we are getting if we are investing 8,000 rupees extra here. So, here you can see 20,000 we are investing here, here we are investing 30,000. So, the extra investment needed is 8,000. So, we say that in A1 we are investing 8,000 extra. So, what is the benefit we are getting out of that? So, that we need to capture it in the terms of a cash flow diagram. So, 8,000 I am putting extra here, and what is the benefit that I am getting? Between A2 and A1, if you see, in A1 we were getting 8,000 benefit and in A2 we were getting 6,000 benefit. So, the extra that we are getting is 2,000. So, you will find that 2,000 additional benefit we are getting, and in terms of salvage value, if you see, in one alternative we were getting 3,000 and in another alternative we were getting 2,000. So, we are getting this as 1,000. So, this is the cash flow diagram, and we say this the incremental cash flow diagram, of A1 over A2. So, this is how we represent the cash flow diagram, and now we calculate the NPW for this cash flow diagram again, which will be given as minus 8,000 plus 2,000, P given A 20%, 10 plus 1,000 P given F 20% and 10. So, this is how you calculate, and I have already done this calculation for you. And if you look at this particular cash flow diagram, this is how you can draw it, and here you can see that the net present worth at I is equal to 20% is given by 546.5. Here again it is coming to be positive, which only indicates that the return that we are getting from this additional investment is more than 20%. So, what does this mean? This means that the additional investment of 8,000 is also giving me a return more than 20%. Now, remember the concept that we learnt in the theory part. We said that every rupee is as good or as bad as the other rupee. So, here what we are finding is that the additional investment of 8,000 also is fetching me a return of more than 20%. So, out of A2 and A1, I prefer A1. That means additional investment is desirable. Now, I compare this A1 with A3. So, if you look at the comparison between A1 and A3, this is how it looks. So, you find that between A1 and A3, you are investing 45,000 rupees extra at time t is equal to 0. And what is the return that you are getting? You are getting annual benefit of 10,000 for next 10 years, and you are also getting increase of rupees 4,000 in terms of salvage value. So, here again I calculate the NPW at I is equal to 20%, and you find that I am getting a negative value. It is minus 2,429. What does this indicate? This means that the internal rate of return for this additional investment of 45,000 is less than 20%. So, that means it is not wise to invest this additional 45,000, and so the conclusion is we stick to A1 and we do not go for A3. So, out of the 4 alternatives A1, A2, A3 and A4, we saw that the first stage screening itself A4 was rejected, and then finally when the second stage of analysis was carried out, we found that A1 is the best choice out of the remaining 3. So, this is how we carry out the incremental analysis in a step by step manner. Now, to reinforce your understanding, I am giving you one more example. In this example, you can see that there are 2 options. We can just first read this example. It says that a supplier of prefabricated railway sleepers procures each piece of sleeper for rupees 4,000. So, sleepers are being purchased for 4,000 rupees, and the demand for sleepers is 350 units every year, and it is estimated that a similar demand would prevail for another 3 years. So, that means there is no change in the demand for the next 3 years. Now, there is another option in which it is given that the equipment to manufacture sleepers is available for rupees 18 lakh. So, that means if you want to manufacture or fabricate the sleepers on your own, then it is going to cost you an equipment worth rupees 18 lakh. The annual operating cost for producing these 350 sleepers is estimated to cost rupees 7 lakh for the first year, and every year you find that there is a 10% increase for years 2 and 3. Now, if the equipment does not have any salvage value at the end of 3 years, the question is, should the supplier continue to outsource it, or should he buy the equipment and start producing the sleepers on his own? The minimum attractive rate of return here is 15%. So, you find this is a classic example of making a choice between producing something on your own versus getting it through some other agency. We call that as outsourcing. So, the 2 options are identified, outsourcing versus producing on our own. Now, the cash flow diagram for each of these 2 options we can produce, and you will find that this looks something like this. For the first option, if you see, wherein you want to procure it through other agencies. So, the demand is for 350 and the rate at which you are procuring is 4,000. So, every year you have a commitment of 14 lakhs. So, you can see at the time 0 there is nothing, but at the end of year 1 we are paying 14 lakh, at the end of year 2 we are paying 14 lakh, and at the end of year 3 we are paying 14 lakh. So, this is as far as the cash flow diagram for outsourcing is concerned. On the other hand, if you look at the equipment option wherein we want to manufacture on our own, so the cash flow diagram is slightly different. You remember the 18 lakh is the cost of equipment. So, at time t is equal to 0 itself, we are going to invest 18 lakhs. This is how it looks, 18 lakhs here at time t is equal to 0, and then when it comes to year 1 and 7 lakh, and then it is increasing by 7% 10% every year. So, 7.7 and then finally, it is going to be 8.4. So, this is self manufacturing cash flow diagram corresponding to self manufacturing, and then we also have the cash flow diagram against outsourcing, which is common 14 lakhs every year for next 3 years. So, these are the two cash flow diagrams. This is an year 1, 2 and 3. This is year 1, 2 and 3. So, you have to make a choice between self manufacturing versus outsourcing. This is outsourcing. This is outsourcing example. So, this is t is equal to 0. You do not have to do anything. Every year you are procuring sleepers worth 14 lakhs. On the other hand, if you want to manufacture on your own, 18 lakhs you have to invest at time t is equal to 0 itself. Then the first year the operation cost would be 7, then the next year it is 7.7 because it is increasing by 10% every year, and the next year it is going to be 8.4. So, since these are the only two alternatives here, we can solve this problem using the concepts of either the present worth method or future worth or even annual equivalent method. But suppose if we have to solve this particular problem using incremental method of analysis, how do we do it? Now, in earlier lectures you have already been told that it is not possible to find out the internal rate of return for a cash flow diagram which is only cost dominated. For example, if you look at these two cash flow diagrams, you can very clearly find that they are all cost dominated. What does this mean? There are entries only in the minus side. So, for such examples, finding the IRR is not possible. So, if you want to use the concepts of incremental analysis, we have to slightly modify the cash flow diagram, and you have to understand it in a slightly different manner. So, what is happening here? We have to understand it like this. At time t is equal to 0, in outsourcing we are not spending any money. So, this is 0 money here, but if you are manufacturing you have to invest 18 lakh. So, if you are investing 18 lakh at time t is equal to 0, we will see what is the benefit we are getting out of this. So, we can revise this cash flow diagram in a slightly different manner, and we do it like this. So, the way we understand it like this is, what is the benefit you are getting if you are investing 18 lakh at time t is equal to 0. So, if you remember, in the self manufacturing case, we have to invest 7 lakh for the year 1, whereas if we are going in for outsourcing we are investing 14 lakh. So, that means we have a saving of 14 minus 7 in year 1. In year 2, what is the saving? We have a saving of 14 minus 7.7, and in the third year we have a saving of 14 minus 8.4. So, this is how we have to interpret. So, we are saying that if we are investing 18 lakhs extra at time t is equal to 0, I am getting a benefit of 7 lakh here, 14 minus 7.7 at the end of year 2 and 14 minus 8.4 at the end of year 3. So, if you continue to do this, you will find you are getting a cash flow diagram. You are getting a cash flow diagram as shown in this particular slide. So, it very clearly shows that time t is equal to 0, you are investing 18 lakhs, here it is, and at the end of year 1 you are getting a saving of 7 lakhs, at the end of year 2 6.3, and at the end of year 3 it is 5.6 lakhs. Now, the moment you have got this cash flow diagram, you can very easily find out either the rate of return and compare it with the minimum attractive rate of return, or you can as well find the net present worth at the given MARR. So, if you see the MARR here is 15%. So, the easiest way that you can do is you can find it out what is the value of net present worth at I is equal to 15%. So, you can write it like this: NPW is minus 18 lakh plus 7 P given F. Remember, all these values are to be considered as F, and we want to bring it to its time t is equal to 0. So, we are writing P given F, interest rate is 15%, 1 year, then it is 6.3, P given F 15% and 2 years, plus next one is 5.6, P given F 15% 3 years. Now, depending on whether this value is positive or negative, we can make the conclusion. So, as far as this example is concerned, NPW value at 15% is coming to be negative. So, the negative means that we are getting a return less than 15%. So, what does this mean? That means it is still preferable to go for outsourcing, because if you remember what is the basic principle of incremental analysis, that every rupee is as good or as bad as the other rupee. So, if you are investing 18 lakhs extra over and above the outsourcing option, and if this is not yielding a return more than MARR, there is no point going in for additional investment. So, the additional investment of 18 lakh is not desirable, right. So, this is how you can manipulate the cash flow diagram, so that wherever it is not feasible to find the internal rate of return, we can compute it using the incremental analysis concept. So, just to summarize what we studied in this lecture, we studied a particular method called incremental analysis method, which is used when we have to evaluate alternatives more than 2 in numbers. You can still employ this even if you have got less than 2, but whenever you have got one alternative to choose from 2 alternatives, in those cases you can go in for present worth, future worth, or annual equivalent method of comparison. But more than 2, necessarily we have to go in for incremental method, because it is not enough to know that you are getting a return in excess of MARR, but it is also to be enforced that we are also getting a return more than MARR on our additional investment. Then only you can say that additional investment is desirable. So, for that what we need to do? Organize the alternatives in their ascending order of investment, least investment first, then the next higher investment, and so on, the highest investment at the end. Then find the IRR if it is possible, compare it with MARR, take those alternatives only in the next stage of analysis which is giving you an IRR more than MARR. After you have done this, then you take 2 alternatives at a time, compare them and choose the one which is better out of the 2. This way you continue doing this till all your alternatives are exhausted and you are left with the one best choice. So, this is how you have to apply this particular method. So, with this I stop this particular lecture and see you in the next lecture. Thank you very much.